Some investors spend way too much time on picking the right stocks or funds, but they completely ignore what account types they put those stocks in. And that mistake could mean having a much lower net worth. If you're not careful, you could be losing thousands to taxes without even realizing it. Today, you'll see the 3 best ways to invest tax efficiently so you can grow your portfolio and net worth while avoiding capital gains tax where possible. So, if choosing the wrong account means paying more in taxes, what's the right way to do it? By the end of this video, you'll know the difference between Roth IRAs, traditional IRAs, and a fully taxable account. Which of these strategies can you actually use based on your income and situation? How easy it is to set up a tax-efficient investing plan so you don't have to stress over taxes every year. Think about investing like choosing a road to drive on. The path you take affects how much you'll pay along the way. The IRA is like a toll road. You don't pay anything up front, but every time you take money out in retirement, you owe taxes, just like paying a toll when you exit. The Roth IRA is like a freeway. You pay up front with taxes today, but then it's smooth sailing, no taxes on future withdrawals. A taxable brokerage account is like a city street. You stop at every red light, paying taxes every time you sell. Now, that you know how different accounts are taxed, let's talk about how to use this to your advantage. The first and easiest way to manage taxes is by using tax-advantaged accounts like Roth IRAs and traditional IRAs. A Roth IRA is best for people who expect higher taxes later. You pay taxes today, but your money grows and can be withdrawn tax-free. A traditional IRA and 401k is best for people who expect lower taxes later. You get a tax break now, but you pay taxes when you withdraw in retirement. Roth IRAs have income limits, though. If you earn too much, you can't contribute to them directly. And a common mistake is by thinking a Roth IRA is always better. If you're in a high tax bracket now, but expect lower taxes in retirement, a traditional IRA or 401k might save you in the long run. For example, if you're making $400,000 a year today, but you expect to retire with a $100,000 income, a traditional IRA lets you defer taxes at your high marginal tax rate now and pay a much lower rate in the future. Not all investments should go in the same type of account. Some belong in tax-advantaged accounts, and here's how I would consider splitting them up. A taxable brokerage account is best for stocks, ETFs, and municipal bonds. All of these different investments could have a low tax impact. IRA and 401k are best for corporate bonds, REITs, and actively traded stock funds. These tend to have a higher tax impact. A Roth IRA is best for your highest growth stock or most aggressive fund because these compound tax-free. You're going to be able to compound that growth much more in the future. Think of these different accounts like meal prepping. Some foods stay fresh in the fridge, others need to go in the freezer. If you store them wrong, they spoil faster. Just like choosing the wrong account can lead to higher taxes or worse overall returns, if you put high tax investments into a taxable account, you waste money on taxes every single year. But store them in a tax-advantaged account and you keep more of what you earn. A client of mine actually had a tactical mutual fund, a fund that has a lot of activity in it, inside of a brokerage account. Since he didn't know that gains in a mutual fund pass through to the investor, he wound up paying taxes on a fund that he never sold. This was confusing to him until he saw how mutual funds worked. Now, what if you have a Roth and traditional IRA or 401k and still have more money to invest? Even with the best planning, you'll eventually have to deal with capital gains taxes, but here's how to reduce them. There's a strategy called tax loss harvesting that reduces your overall capital gains tax exposure. You use tax loss harvesting by selling stocks or funds that have experienced a sell-off to offset gains. Those harvested losses can also offset up to $3,000 of ordinary income per year and carry forward any extra harvested losses in future years. But pay attention and reinvest intelligently. If not, you'll violate the IRS wash sale rule. You can't buy the same stock or fund back within 30 days. A pro tip: losses in one account can actually offset gains in another. For example, a $10,000 loss in your brokerage account can offset a $10,000 gain from a real estate sale. A common mistake is also waiting until year end to think about taxes. Tax planning is something you should do year round. Now you know how to minimize capital gains tax and how to invest smarter. But here's the thing: not everyone qualifies for a Roth IRA, and the rules can get tricky. If you're wondering whether you're eligible and what to do if you're not, I've got you covered in my next video. Click here to watch now.